Not all retirement withdrawal strategies are created equal, which makes sense because not every retiree's goals are the same. Some people are retiring well into their 70s. They realize that they likely don't have many years left to go, and they're not too worried about outliving their money. They just want to enjoy life to the fullest for whatever time they have left. For those people, more dynamic withdrawal strategies such as the 1/n method may be a viable option to fit their needs and wants. Other retirees are retiring at a more normal age, or perhaps slightly early, and they expect to be needing to withdraw from their nest egg for 20 or 30 years. These people may have a little bit more concern when it comes to outliving their money, but in comparison to the bare bones early retiree, maybe not so concerned that they'd be willing to forego too many of the lifestyle perks that they've become accustomed to over the years. As such, many of these retirees may want to adopt a more moderate to conservative withdrawal strategy. Still others are retiring incredibly early, or just wish to leave a lot of money to their heirs, or a charity or cause when they pass on. For these individuals, a truly conservative strategy may be in order. But as you can no doubt tell by the title of this video, in today's video we're going to be continuing our series on retirement withdrawal strategies. Today we're going to be covering a strategy called the 3 buckets of retirement withdrawals, or the 3-bucket strategy for short. As always, we're going to be going over what the 3-bucket strategy is, why we would use it, who it would work well for, and of course, its pros and cons in comparison to other popular strategies. Let's get started. Hey everyone, Daniel here, and welcome to Next Level Life, a channel where you can learn all about investing, debt, retirement, and many other financial topics besides, because let's face it, the schools aren't going to teach it for us. So if any of those topics sound interesting to you, or if you want to learn how to better handle your money and have more financial freedom, be sure to hit that subscribe button and the bell next to my name to be notified every time I upload a new video. And if you want to further support the growth of this channel, you can smash that like button if you haven't already, share this video with a friend, and leave a comment below letting me know what topics you'd like me to cover in future videos. So the 3-bucket strategy is a fairly simple strategy to understand on the surface, even if the calculations can get a bit more complicated when we put it into practice. The basic idea is that you divide your investments into 3 sections, or buckets, each with different purposes. The first bucket is usually any money that you will need in the near future. Just for the sake of this video, let's say the near future is 2 years. But just know that there really isn't a standard time frame for this. It all depends on your situation, goals, and of course, risk tolerance. This first bucket usually contains very safe investments. Think of things like cash and cash equivalents, such as treasury bills, money market funds, and the like. And they should be enough to cover all of your ongoing expenses that aren't already being covered by things like Social Security, pension checks, or any side hustle income that you may have. And when I say all ongoing expenses, I mean all ongoing expenses. Be sure to include the major ones that aren't necessarily month to month, but do come up from time to time, like vacations, new cars, and home repairs. Now this bucket isn't going to make you much money, but in this strategy that's not its purpose. After all, when you get fire insurance, you aren't going to get mad when your house doesn't burn down. This is sort of like market crash insurance. It's the money that protects the money that makes you money, by giving you another option for income that doesn't involve selling your investments when they're at their lowest point. The second bucket is for any money that you will not need in the next 2 years, assuming that's the time frame you used for the first bucket, but money that you will need within the next, say, 5 or 10 years. And it generally contains slightly more risky investments, or sometimes just less liquid investments than the cash bucket, such as bonds, and sometimes fairly safe blue chip type dividend-paying stocks. The major purpose of this bucket is to earn enough money through the interest and dividends, as well as hopefully some small appreciation over time, that it can refill the first bucket as time goes along. Think of it as your income bucket, whereas the first bucket would be more like your spending bucket. The third and final bucket is used for long-term investments that won't need to be touched for the next 5 to 10 years or more, and are generally more of the high-risk, high-reward variety. Some examples of investments that may go into this bucket are stocks, normally those with higher growth potential, real estate, and sometimes alternative investments like commodities or things like cryptocurrencies might also go here. And again, don't get hung up on the time frames I'm using for the buckets in this video. They aren't hard and fast rules. Some people will use longer or shorter time frames for each of these buckets depending on what they're trying to accomplish. But those are the 3 buckets. You've got your spending bucket, your income bucket, and your investment bucket. And now you may be thinking to yourself, well, that all sounds fine and good, but why exactly would we need this strategy when we could just use something like the 4% rule? And the answer is, for some of us, we don't need it, as we'll discuss later with the pros and cons. But it is true that some people don't like the idea of a systematic withdrawal system, like the 4% rule, because of the risk factors that are involved with using them. For example, if you're retired and following the 4% rule to a T and the stock market crashes, you still need money to live on, and unless you have income coming in from other sources, like we talked about with Social Security, pensions, or side hustles, you're going to need to sell some of your investments, potentially at a significant loss, in order to put food on the table. This can have a tremendous effect on your chances at success, as I detailed in my video on whether or not the 4% rule is actually safe. As we saw in those videos, almost all of the times where the people ran out of money using the 4% rule was when they had a major stock market crash occur pretty much right at the beginning of their retirement. Because think about it, if you have a $1 million nest egg invested in the stock market when you finally decide to hang up your boots for good, but then the market has a gigantic crash like the one we experienced back in 2008, that nest egg could look suspiciously like $500,000 pretty darn quick when you go to withdraw the money. And if it takes the market, say, 3 years to recover to its original value before the crash, you could still be looking at a significantly smaller nest egg if you were following that 4% rule to a T. Just to illustrate how big of a difference this can make, here's how this could look. You retired with a $1 million nest egg. Hypothetically, let's say it's invested in a stock with a share price of $100. This means you have 10,000 shares of the stock when you retire. And I know that that's incredibly unrealistic to have your entire retirement savings in one stock or mutual fund, but this is just to illustrate the example. However, the stock market crashes, losing 50% of its value during your first year of retirement, and you withdraw $40,000 that first year because that's what the 4% rule would have had you do with a $1 million nest egg. At the end of your first year of retirement, this would mean that you have a nest egg worth about $460,000 thanks to the crash and the withdrawal. In your second year of retirement, your investment starts to recover, gaining 20% for the year as a whole and bringing the share price back up to $60 a share. This raises the value of your nest egg up to $552,000, and since you still need money to live on, you withdraw some more for the year. In order to keep your buying power the same, as the 4% rule attempts to do, you would withdraw $40,800 to account for inflation, which for the sake of simplicity we'll say is about 2% each year. This leaves you with a nest egg of $511,200 at the end of the year. In your third year of retirement, the market continues to recover, growing by another 20% and raising the share price of your nest egg's investment to $72 per share. This brings the value of your nest egg up to $613,440. But again, you still need money to live on, and in order to maintain your standard of living, we again need to adjust for inflation. This time you withdraw $41,600 to account for that inflation. This leaves you with a nest egg of $571,840 at the end of the year. In your fourth year of retirement, your investment fully recovers the rest of the way with the stock price reaching $100 per share. But this only brings the value of your nest egg up to just over $794,000 before your withdrawal, and about $751,000 after your withdrawal. So while your investments have technically fully recovered from what would have been one of the worst crashes in the history of the stock market, you're sitting with a mere 75% of the money that you had when you first retired, thanks to being forced to sell some of your shares during a huge market downturn. Not ideal to say the least, but it is an absolute eventuality for those strictly following the 4% rule in retirement, assuming of course that they have no income coming in to support themselves outside of those investments. If they do, then they may be able to live off that during the hard times and basically nullify this negative point altogether. And while you can certainly do some things to somewhat mitigate this disaster of a situation from harming your nest egg, even without another income source, such as figuring out ways to lower your burn rate and lower your standard of living during market downturns, but neither of those solutions will stop the damage entirely. They'll just lessen the effect of it. So that's why some people prefer to use the 3 buckets strategy. It's all done in the interests of avoiding this eventuality as much as possible. I like to think of it as the debt snowball of retirement withdrawal strategies. It may not be the ideal mathematically, which again I'll come back to in a minute, but it can be something that helps someone mentally and emotionally become comfortable with the idea of retiring, assuming worry and stress is the only thing realistically holding them back. So now that we know what the 3-bucket strategy is and why some people would use it, how exactly does it work in practice, and what are the pros and cons associated with it? The implementation of this strategy can vary a bit from person to person, but generally speaking, it works something like this. Let's say that John and Jane have decided to retire, They want to maintain their current standard of living, spending $40,000 a year as we saw in the example earlier, and this is entirely doable thanks to the fact that they are retiring debt and mortgage-free with a nest egg of $1 million. That means that they could, if they wanted to, follow the 4% rule for their withdrawals. However, in an effort to avoid having to draw from their investments during a huge market downturn, they will instead be using the 3 buckets withdrawal method. And because of this, they don't actually have $1 million invested in stocks and bonds. They've decided to have 2 years worth of their expenses, or $80,000 in this case, invested in short-term cash and cash equivalents, or in other words, in their spending bucket. They have 10 years worth of expenses, or about $400,000 in their income bucket, which is mostly comprised of high-yield bonds that are generating roughly 2.5% per year in interest, or about $10,000. The last $520,000 of their savings is in their investment bucket, and is comprised of several higher risk but higher reward stocks. These are mainly growth stocks that are early on in their growth cycle, and as such aren't really paying out many dividends to their shareholders, so unfortunately there's no extra income to be had here from year to year, but John and Jane are hoping that these investments will grow over time. John and Jane currently make nothing from Social Security, and like most of us, won't have any pension or side hustle income to speak of in retirement. So they'll have to refill their spending bucket entirely with their income bucket as time goes along. And since we're comparing this method to the 4% rule, it only makes sense to go with a scenario that tests the 4% rule to its limits. So let's go back to the example we used earlier, where John and Jane's investments, specifically those riskier investments that are in their third investment bucket, start out at $100 a share but drop to $50 a share, or lose 50% of their value, in the first year, and don't recover until the end of their 4th year of retirement. We saw what happened using a very systematic safe withdrawal strategy under those conditions. John and Jane lost about 25% of their nest egg. However, the same thing does not happen with the 3 buckets strategy, thanks to the focus on having cash on hand as well as income-producing assets. However, since their income bucket is only giving them $10,000 a year, and they're pulling out $40,000 a year from their spending bucket to live on, they're going to need to cash in some of those bonds as time goes along to make up the difference. And this difference will increase over time thanks to inflation, which, to keep things consistent with the previous example, we will again say is 2% per year. So when we plug in all the numbers, adjusting for inflation and cashing in things from our income bucket when needed to get our spending bucket up to that 2 years worth of expenses at the end of each year, we see that our ending net worth using the 3 buckets strategy is about $841,600, which is nearly $90,000 more than it was in the previous 4% rule scenario. At the end of the scenario, John and Jane's money is split up like this: $80,600 in the spending bucket, $241,000 in the income bucket, and thanks to the fact that we didn't actually have to sell off any of our investment bucket assets during the crash, John and Jane still have $520,000 in their investment bucket, because it lost 50% of its value and came right back up to where it was before. So the biggest pro to using the 3 buckets system, as opposed to other strategies like the 4% rule, is obvious. It gives you some peace of mind if a major market crash should happen at some point during your retirement. And let's face it, if your retirement is long enough, there's going to be a crash at one point or another. However, the downside of using the 3 buckets strategy is equally as obvious. As I'm sure many of you have already been thinking to yourself, the fact is that since you're keeping possibly 1, 2, or even 3 years worth of your expenses in cash or cash equivalents, you aren't making very much money from that portion of your savings. And unless your expenses are incredibly low, having your growth potential limited like this could make a huge difference in your net worth, especially over longer retirements, in comparison to different retirement withdrawal strategies. I mean, we looked at a fairly short scenario today simply to quickly illustrate the difference that these 2 strategies could have in less than ideal times. However, it's not exactly common for the market to lose 50% or more of its value in a single year. It's actually really rare in the grand scheme of things. And over the long haul anyway, the market has average returns of roughly 8% per year. So say if John and Jane had lived for 30 years in retirement, and over that time averaged a rate of return of 8% per year, but instead of using the 3 bucket strategy, and leaving that $80,000 of their savings in cash, they took the risk and put everything into their actual investments. $80,000 at 8% per year for 30 years is about $805,000. Even at a more conservative 6% return, it still ends up netting John and Jane an extra $460,000 over the course of their retirement. So depending on how long your retirement goes and how much you have saved in relation to how much you spend, and how many crashes you experience during your retirement, this may end up being the difference between having enough money to live out your full retirement and outliving your money. So where exactly does this leave us? Who would this strategy work well for? Well, I personally feel that it's well suited for people who may be a little extra worried about having to sell off their investments during a crash. People who are willing to work a little bit longer so that they can still have enough invested in their second and third buckets to make up for any potential growth that they're losing by keeping so much money in their spending bucket, and those people who wouldn't likely have any other income outside of their investments during retirement. But I'm going to open the floor to you. What do you guys think about this strategy? Do you think this would be a good strategy for you to take advantage of, either throughout your whole retirement or maybe just a small portion of it? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.